As we've been discussing with my colleagues here, I've been taking notes. Figluski just mentioned 40% increase. We actually had one a couple weeks ago, Monday, on the day that Comey was fired. The VIX went up 40%, the S&P fell 40 on the day, and the VIX went back, right back down right after that. So it shows so forth. I'm not an expert in the VIX options, but I do have a pile of the equity ones for September 10s, because I study things like sell in May and go away, which has the following results the last 20 years in the futures markets. May has been up the last 6 years, but May to the turn of the month of November, the top turn of the month of the year, is basically such that if you went to cash on May 1, you get 2.5 times for the small caps and 2 times for the S&P with less risk. So if there's going to be trouble this year, it's likely to be in August, September, early October. So there's that issue. So I have a certain amount of time and so forth. We're going to do I have a teamwork here. Sebastian's passing around our book, and very excited about it, because we do the following things in the book. The first thing is, how many crashes are there, and how many do people expect? How many crashes do you think are more than 10% in one day? How many do you think? So how many crashes do you think in the United States from 1900 to now are more than 10% in one day? It's the same number as the number of undefeated horses by the Ziemba rule. The Ziemba rule is you have to be undefeated, tough competition, and no losses, tough, the best competition, at least 10 races. There's exactly 2 horses in America. There's exactly 3 in Europe. And there's exactly 3 more than 10% in America in the last 100 years, plus, so forth. Now, what we're going to do in the talk, I'd like to sort of talk about the book for just a sec. So we do that. We also do the following. The bond stock measure, which we'll discuss, which has the bonds fighting with the stocks for the money, which I've used since Japan 1988. We had a paper, Sebastian and I, and we showed that in the period 2006 to 9, China we predicted, the US we predicted on June 14th, 2007, with the S&P at 1,500, and also Iceland. Now, I showed the paper to Harry Markowitz, and he says, Bill, that's very interesting, but it's a 3-year period. How about doing a 50-year study, comparing it with Schiller, who's on TV all the time, saying that there's always trouble. And so Sebastian and I did it, and we have a 90-page paper. Oh, can you go to the beginning? We have a 90-page paper in the Anthony Saunders NYU Journal. We also have in there a chapter on Marty Zweig. Marty Zweig had an apartment in New York that was more expensive than Donald Trump's. And he did it with momentum and Fed movements. I use Fed movements all the time, and options expiry, and these sort of effects. We also have a wonderful chapter, if you don't mind. I have, in addition to this wonderful young man helping me, I have another one who's actually sitting in Moscow at the Steklov Institute, and his name is Mikhail. And Mikhail and I have been worked on how do you exit bubbles at a good time and price. So we have a chapter on that. We use Russian mathematics. And my idea is to look at all sorts of markets like 1929, 1987, and then these sort of things. So anyway, we plug our book. I fought with the publisher. It's $28 for a paperback. If you cannot make $1 million on this book, I give up. So the next slide. Oh, Sebastian. So financial bubbles. I'll talk for part of it, and then Sebastian will do the hard parts. Could I have the next slide? Various bubbles. Here's some different bubbles over time. Could I have the next, please? There seems to be a lot of crashes. Now, this business that we've discussed as to why the volatility is so low right now is really kind of a puzzle. I have no explanation as to why it's so low. It's just that I'm assuming there's going to be disaster later. Now, we define a correction as 10% fall from the beginning. So we have a period and so forth. And in almost every case, and I've done many countries in the last 30 or so years, almost always when this measure goes in the danger zone, you have a crash. There's no getting out of it with monetary manipulation, et cetera. Once you get into the zone, it's sort of like you've had it. There's going to be a decline. Now, when I first did it in Japan, I looked at the crash of '87, and which I've studied extensively in different writings. And then I applied it to Japan, 1948 to '88. And there were 20 declines of 10% or more in that period. 12 times this measure was in the danger zone, 12 times it worked. And then at the end of '89, I sent the fellow who had from the school in America with the highest rating on a mean variance criteria, Ishii. He had studied at Yale, and they had only one professor, and his name is Ross, and he had a high mean. So you can see how misleading the mean variance models can be. Anyway, Yamishi would not listen to him, and 6 years later, they were bankrupt. They went under because they didn't listen, etc. Have the next. These are the declines that we isolated in the U.S. market, etc. Can I have the next, please? Now, crash models. Now, I worked on the bond stock. Schiller and John Campbell are associated with high PE. Now, actually, in a book that Marita Bertocchi and my wife Sandra and I did, we found that if you take 20-year periods with high returns, they invariably start with low PE and end with high PE. So that's what we found, et cetera. Now, the third thing is Warren Buffett's measure. Warren Buffett has a measure where he says you have the value of the economy to the value of the stock market. And he has fixed limits above a certain amount or below a certain amount. But what Sebastian and I found was it does not predict. Buffett is, of course, I have great esteem as a fantastic investor, but we fixed it using curves. And I mentioned the stuff that Mikhail and I and Alexander Shuryev have done. Thanks. Now, here's a bunch of different kinds of models. Gutzman and Schiller have behavioral stuff. I've worked with Shuryev and Mikhail, and Prater and Gero have nice models on when is it actually a bubble, and then we have in our book 4 big crash measures and then explanation of many of the other ones. Can go to the next. Now here's the PE ratio. Goes back to Benjamin Graham. Go to the next, please. And here's Schiller himself, who, by the way, was predicting doom for years and years and years. finally his book came out. He was consistently wrong, but he was able to capture luck. I guess if you're teaching at Yale, you get a lot of luck. And the luck was the book appeared exactly when the market fell. And he had sold the most copies in the history of Princeton University Press. So anyway, he's still negative all the time. But I must say, I really like his real estate stuff. Can I have the next, please? And this is me with the bond stock measure as well. There is a so-called Fed measure, which gets a lot of press. Of course, as usual, I did it before that, but they get the credit. I didn't even know about me. But anyway, the Fed measure is the bond stock measure when it's equal to 0. The normal case is when the long bond exceeds the cash return from the PE ratio reciprocal. Thank you. The next, please. And of course, here's Warren Buffett looking good. We have the same birthday. I'm very pleased that I have the same birthday as Ted Williams and Warren Buffett. So forth. Anyway, this is his measure. Could I have the next, please? We found that basically it doesn't predict. Can you go to the next, please? Here's the way he does it. Straight line there, and if it's above a certain level, you get out. If it's below, you get back in. But it actually does not predict. Can we go to the next? So forth. It reached its peak in methodology. Here, go ahead. Can I have the next, please? Now, this is where we're going to go to the my star.
Yes.
Yeah.
Thank you. So I'm going to do the easy part, which is the methodology. Basically, all of these crash signals work, or most of them work in the same way, which is that we are just computing, we're just looking at when a measure, whether it's the P ratio, the BACYD, or a modification on Warren Buffett's MV to GNP ratio, crosses a threshold. So this threshold is computed quite easily as just a confidence interval, or if we want, using Cantel's inequality, which is a one-tailed version of Chebyshev's inequality. When we compute this threshold, we only use information past data. We don't cheat, we don't use things that are not available on that day. Now, if you're talking about prediction, you need to have a prediction horizon, so we set the prediction horizon to. And the trick when you're just trying to build a model is to have a model that's tractable and something that you can test, on which you can really have inference. So to do that, we do a little bit of work here by redefining everything in terms of indicator function. Just a little red flag, basically telling you, hey, we've got a signal, meaning, hey, our measure is so high that it has crossed the threshold, and now we are in the danger zone. So we convert that into a 1 or 0 sequence. 1 meaning this is the first day when our signal has turned positive. And of course, if we want to do inference, we need to keep track of how well the measure is doing. And to do that, we've got a crash indicator that looks at our prediction horizon and turns to 1 if there's going to be a market downturn, a correction, a crash over the horizon, and stays 0 otherwise. Once we've converted that into just a series of 1 and 0s, we've got actually a model that's incredibly easy, because all we've got to look at is really this probability, the probability of getting a correct, the probability of getting a correct prediction, which is the probability that a crash is going to occur over the horizon, conditional on having had a signal that something was about to happen. And this is just looking at basically a Bernoulli trial. Once we've got a Bernoulli trial, not a Bernoulli trail, Bernoulli trial. Once we've got our Bernoulli trial, we can just estimate everything estimate our probability using log likelihood. We've got a nice, clean analytical formula. That's really standard textbook stuff. And once we've got that, we can also run our inference. So what we really want in order to be able to tell whether our measures perform well or not is simply to set up a hypothesis test. Very simple. Is the success rate, the probability of correct prediction, equal to some uninformed probability? So that's our H0, and hopefully we are going to reject it. Now, I always enlist the help of world-famous Chip the Chimp. Chip the Chimp is basically a monkey, and I'm asking Chip the Chimp to just pick a date at random, and then I keep track of how accurate Chip the Chimp is. That's what P0 is. It's the probability of forecasting a crash given that you've picked a date randomly. Now, as everything is so easy in our model, we can just test this hypothesis with a simple likelihood ratio. Asymptotically, the test statistics is chi-square distributed with nu is equal to 1 degree of freedom, and we can perform the test at a 90, 95, 99% confidence interval. Now, the key word here is asymptotically, because while we have had 22 crashes in 50 years in the US market and 22 crashes in 27 years on the Chinese market, but still 22 is not that many from a statistical perspective. We can't claim that we are asymptotic or close to asymptotic. So that's why we also perform Monte Carlo study for small sample bias. Here again, we get all this analytically. In France. And as we're at it, we also look at optimal parameter choice, parameter robustness, and we also have a new definition of robustness, as well as a robust statistics and robust test. Now I'm going to pass it on to Bill to talk about the fun stuff, which are 4 of the recent studies that we've done.
Thank you. Thank you very much. Thanks, Sebastian. So the long-term study, so could you go back there? Long-term, Harry Markowitz suggested that, and I've talked about this. And then we have a study of the Chinese market. In our earlier paper, which was published in Quantitative Finance, we did do the China crash in the 2006 period. It was kind of a crazy one, because it went up a lot and then down a lot, but the model did, in fact, work, et cetera. So we have some stuff in the Chinese markets. But before I go along, if you don't mind, I'm always off the track, as my wife will tell you. Let me tell you a strategy that wins in China. You can do the following strategy. You buy every stock, the call and the put, at the money. You go long both sides. And because the volatility is so great, it is a beautiful graph of winning. It's a beautiful graph. I've talked to people. It's a strategy that they propose in China, which is crazy, of course, from our point of view, but so forth. Now, here's the study. Now, go ahead. These are the models we do. It's log PE and PE and BSEUID, which again is long bond, most liquid against the PE ratio, and the log. Can we have the next? And then computing the empirical stuff, and these are likely to, we'll go quickly through this. I'd like to concentrate on the key ideas. The next page, please. And then we did Monte Carlo ratio tests. Go ahead. And now, when we do Warren Buffett's method, can I have the next, please? It turns out that it only predicts 2 out of 11, and it's given here. But the thing is, if we use, you'll see their signals, it predicts 2. We get 8 out of 11 if you apply essentially the way we do it for the bond stock. So, can you go to the next, please? Then like so forth. And then, Sebastian, why don't you talk about the China? Yeah. Yeah.
Go very briefly, first because I already talked about it, so not only are you going to get a feeling of déjà vu, but I'm going to get a feeling of déjà vu. But we did this study, a similar study on the Chinese market, because the Chinese market is very interesting, it's very large. If you take together Shanghai and Shenzhen, you get something that is very close to the Nasdaq in terms of size. And it has a number of very interesting properties from a statistical perspective, including the fact that it has had many downturns. And we find that on two studies, a long-term study and a short-term study, the P ratio worked very well on a 27-year horizon in both Shanghai and Shenzhen. Now, on a shorter-term study, we got some surprise. We got some surprise because we just had 9 years, which means not that many crashes. In Shanghai, the methods that we tested, whether it's the P or the BSEYD, didn't work very well, but in Shenzhen, they work spectacularly. So I concluded the last talk by saying that actually we need to dig a little bit more into it. But still, the bottom line is, if you look at the longer term stuff, and if you look at Shenzhen, the measure that we tested do contain some information and have some ability to predict on developed market as well as developing market. So the word of conclusion, and we will be on time.
Yeah, sure. One thing that Sebastian we didn't quite cover is that the Shanghai market is large caps and the Shenzhen is small caps. So there seems to be, in all my studies on anomalies, I find invariably that the effects of small caps are much more pronounced than the S&P, and it's a better signal as to what's going on. For example, if you play the turn of the month effect in the United States market, which is to go long on the -1 day and close on the +1 day, the end of the month. You do it in 1 day for the S&P, but you do it for 5 days with the Russell small cap as well. So what we found over time was that the bond stock works pretty well as a measure. You need extremely high interest rates in addition to high PE. So at the moment, so one question I'm sure someone will ask is, what is it saying now? And basically, all 4 of our large crash measures, which is the bond stock, I have a measure based on puts and calls. If the prices of the calls are higher than the prices of the puts, it's a crash measure. But it's only occurred 6 times since 1985, but the cumulative return on the S&P the next quarter is -41.7. But the good news is the last time we had a signal is 2003, but we had a 2002 and an 87. And then the third crash measure is Buffett. And the 4th crash measure is a Donald Trump kind of crash measure, which is the value of Sotheby's stock. And the idea is very simple. The smart people like Donald Trump, who shop at Sotheby's and buy expensive things, are just smart enough to get out just before the market crashes. So when Sotheby's stock goes way up, that's a prediction of crashes, and we have a beautiful graph in the book that shows that it actually works in terms of predicting. Thank you. I'm sorry I'm rambling, but there's all sorts of ideas that are fun from all the talks, and It's a great pleasure to be here. And I thought that the brochure that the organizers put together of the things is one of the best I've ever seen. It's a collector's item with the beautiful pictures and everything. So thank you very much.
We still have a couple of minutes for questions, please. Yes.
It's all great fun, and thank you for the presentation. I guess the practical question is, so what do you do about it if you know there's a crash? And essentially, what do investors do, and what do we know? Some of the work that I've been doing lately says that, okay, do we respond to extreme risk or regular risk, or what are there cultural differences in some of the things that are...
Lauren, you might enjoy our Chapter 8. See,
Right.
in Chapter 8 of our book, what I do is we talk about 8 different crashes that are small ones that some of them made sense. Let me tell you one that's interesting. The market says we have not had a 10% correction in 7 years. And every day they're saying, we haven't had this correction, we haven't had this correction. Every day they're saying this. So what in fact happened? The minute it hit 10%, because I watch, midday, in the middle of the day, it hit 10%. It just hit the 10% mark, guess what? Turned right around. But it never was 10% closing prices. Okay, so what I tried to do was to talk about, at least for me, corrective action. As my wife will tell you, it's taken me a while to become a better trader. And there's this concept of 10,000 hours. You have to put in 10,000 hours before you figure it all out.
Right.
So you write the books, you do the papers, you try to make sense. And for example, you trade off Yellen. Yellen is almost always positive. And options expiry is almost always positive. And if they both are together, it's a double whammy. That's what we have this week,
Right.
coming up the next few days. So you look at the different effects. Now, the kind of stuff that I do, anomalies, is totally out of fashion. It's a hard sell. It's hated by finance academics, etc. But the thing is, it does seem to work. And people like my friend Thorpe and other people are able to do things. In terms of evaluating great investors, I was teaching at MIT in the Sloan School, and I had the visitor from the Ford Foundation. And he gave a nice talk, and the student said, well, he had a better Sharpe ratio than Warren Buffett. And the student said to me, well, this guy, is he really smarter than Warren Buffett? And I said, well, it's a bit of a fake. But then I figured I got to have a measure that will show that Buffett is in fact better. And the measure I actually had in our book, Invest Japan, 1991, which is to get rid of the gains, have fictitious gains which are equal to the losses, flip the thing as symmetric, and then modify the Sharpe ratio to a downside Sharpe ratio. And guess what? Buffett's the only one who improved. Soros and Ford and all those were so far. So in the end, Buffett and Ford and Harvard, when they were good, they're no good anymore. A guy called Larry screwed them up, losing a lot of money. You may have heard of him. Anyway, and it turns out that Buffett wasn't all that great. He was a 1. And then why? Because he has a lot of monthly losses. Every third month he loses. So does Soros. But my friend Thorpe, my colleague, he had a 13.8 because over a 20-year period, he had 3 monthly losses. But then he doesn't say this in his new book, which he got a $500,000 advance on. You can see how jealous I am. He didn't point out the following fact. There was an 8% T-bill rate during his period. And now we have 0 T-bills. So he was got these dribbles all the one. And the highest one I found was 26.4 Renaissance Medallion. and they have the original fast traders. A long trade for them is 8 seconds. And they started by having extremely brilliant people study markets and look at short-term movements. And they still do it. It's a phenomenal system. They have 5 plus 44 fees. The only investors allowed at the moment are the employees who pay those fees. And Simon's has a very good system. He can sit on his porch, smoke a cigarette, and make $1 billion a year by doing absolutely nothing. It's a great system.
Okay, there are more questions. I think Linda, it's in the...
You know, actually, can I tell you something? There's different things. There is a paper by Pontiff. I don't know if you know Pontiff at Boston College. Jeffrey Pontiff has a paper that argues if an anomaly or something is published, how bad does it take? Now, my old friend, the late Merton Miller, used to say that the half-life of an anomaly is 3 years. But I'm a different style person. For me, I give it in the talk, I give it in the books, I tell people, and it really doesn't seem to matter, Linda, because people don't do it. You know, they're just afraid to do things, and also I mean, I think you got to put a lot of things together. You actually have to work. It's like a job, you know. It's not just a piece of cake. One of my friends at Princeton, I was just at Princeton for financial engineering conference on robotic investing, and basically it was terrible to listen to the talks because they don't know anything. What they do is they think they can write a simple computer program, hire a trader, and actually win. I mean, you have to watch these markets. You have to watch what Comey is saying and what is Jared saying, you know, et cetera. I think you really got to pay attention, you know, to really what's actually going on. And I think very few people are willing to do that. So I think that's my argument. For 40 years, I've put all the stuff is in there. The first paper on the so-called January effect I wrote in 1987, and we published, well, we did do one trick, which you might like. We published in a journal called Operations Research, which is a first-class operations research journal. But all the people who would trade won't read that journal, and the people who read that journal won't trade. So it was a guy, and we put the exact rule, exactly the day to exit and enter, and still it worked. And I was at Princeton. I had a very nice encounter with Burt Macchio, who actually has written horse racing papers. So we have a connection, and you know, I figured he'd be a little negative to this kind of stuff I'm doing, but he wasn't. In fact, it's, you know, there's certain styles of people who do the stock market in different ways. For me, I have the 5 camps of the different styles of different people, the efficient market people, the risk premium people, the, you know, different groups. And there's one group that does research and studies and writes papers and books and et cetera. So that's the camp I'd like to, you know, be in.